So as always, we like to begin with the U.S. products supplied. Focusing on gasoline, jet, disti, resid, just to see where do we sit. And you can see that there was that slow move down. We had that nice bounce back up. But look at 2021. You had a similar bounce back up. You had in 2022. You had that similar bounce. And the question is, okay, well, as we get that bounce, well, what does it look like when we start looking at the average? And the average is still remaining below that 14.5 level. So last week, 2 weeks ago, we had demand at 13.989 million barrels a day. We had said that was a bit on the low end, but 15.169 is on the high end now. So again, you had a delay in purchasing for diesel because people were waiting for prices to fall. You had a delay in purchases for gasoline. So product supplied is looking at the movement from the rack or from the refining side when it then moves into a tank and goes to the retail sector. So here's where you look at some of the different things and how that setup is going to look. And we, as we've said, we just see it pulling back a bit. We had that seasonal bump, and that's usually the last movement of summer grade, now fully in winter grade. So again, that's where we're going to see some of this cool off. But the question is going to really turn to what is happening in the distillate market. And when you look at distillate, we had a draw of 3.18 million barrels. When you look at against the 5-year, that's 17.5 million below. But then when you look at the sections or the sectors or the pads as it's broken down, you can see it's really driven by pad 1. Pad 1 is 15.3 million below the 5-year. And the problem is that Atlantic Loop is getting expensive. It doesn't have the amount of product it has in the past because you've seen Russia pull out, obviously because of sanctions. You've seen a lot of this product getting pulled into the east of Suez versus things sitting in west of Suez. So again, this becomes an issue, which is why imports remain low. And you can see that we're moving in the seasonally speaking, in the right direction, but at a much lower point. So again, when you look at the problems and you look at the setup, if we do have a cold winter or a normal winter, because we don't have the Philadelphia refiner, which blew up in June of 19, how are we, which was about 430,000 barrels a day, how are we going to replace that? It's expensive to go from China to the East Coast. It's expensive to go from these places where we've seen build out of new capacity. Where's the new capacity been built? The Middle East and China. So the Middle East makes sense to get here, but does it economically make sense? Are there better markets? Then the answer right now is yes. So that leaves the Atlantic Loop tight, and anything that was supposed to be built over that time period, it really hasn't come to pass. Mexico, Brazil were supposed to be building assets. You can see how long that's taken and the corruption that lives within that. So we haven't seen that really get adjusted, creating and maintaining some of those longer term issues. So when we look at diesel front month, we had said that it was going to come back down to 40, but bounce. And so it had a big extension to the downside. Now we're sitting at about 43, 45. We don't see too much movement up or down at this point because right now this is still going to kind of carry the gasoline crack, which is still problematic. Because for every 1 barrel of diesel you inherently make about, again, round numbers, 2 barrels of gasoline. So where does the gasoline go, given that we can't really export it or the exports can't really go much higher because there's so much gasoline, especially in the Atlantic region. So how do you create diesel and where do you put the gasoline? And again, that's going to create a problem if this weakens at all, because then it's like, okay, well, diesel can no longer carry the weakness in the gasoline crack, and that's when you get economic run cuts. We don't see that happening in the US. That's something that could happen in Europe as well as Asia, and that's going to be an important thing to watch, especially as we go into the beginning of next year. And again, moving further and further down that rabbit hole of new production. New needs for distillate. So then when you look at pad 1, you can see that we're right around where we were in 2022. Obviously a huge problem when you look at where the demand sectors are, and you can see the massive gap. And the question is, how do you fill the gap? We can't meaningfully bring it from Houston up to pad 1 because, again, it's just a matter of how many Jones Act vessels are available and how are you kind of going back and forth and trying to manage some of these different pieces. Pad 3 still staying fairly normal. They've seen a drop in exports because it does make sense to try to sell as much of this as you can into the Pad 1 and even into Pad 2 to a small degree. So again, you're seeing that backfill up, but you're beholden to rail and pipe and truck. Truck is still expensive. Rail is seeing a bit more opportunity. And then that just, again, sells out on the Colonial Pipeline side. So then when you start looking at products supplied, you see that big drop, big increase. This will start to level off. We do see this going back below the 5-year average, and here's some of the reasons why. We've seen another little bit of a slowdown in market demand. But then when we look abroad, when you look at the Baltic Daily Index, you can see global ocean container rates have just hit a 5-year low after that brief rise, which we said people were just taking advantage of some of the availability. And now you're seeing that steep drop off. And peak season didn't last long as demand began falling again last month and has driven ocean container rates down to a new year-to-date and a 5-year low, which again doesn't bode well for purchasing, doesn't bode well for flows, especially what has to be moved in the U.S. Outbound tender volume showing seasonal softness. If history is our guide, not much on the horizon until 2 weeks after Christmas. 2 weeks before Christmas. Rejection rates are still historically low at 3.85% nationwide. So again, you're still seeing a volume problem that is realistically slightly better than 19, but still at a 20, when you look at it in terms of 2022, when you start to see that pressure point, and we do see that continuing to fall and continuing to weaken as you see this movement going down, which again doesn't speak well for diesel demand, distillate demand in the near term. Then when we look at rail, rail had a nice little bounce, and that was driven again by petroleum products, which isn't surprising. Motor vehicle parts and metals are continuing to be advantageous for rail, but it's taking product and volume away from truck and putting it on rail because guys are like, look, we have to wait. We have to try to manage cost as best we can, given the UAW strikes, these issues in general. So that's benefit for the rail, but again, the trucking side consumes more diesel. So you're seeing some of this pivot over here. Intermodal, 2% better. But if you think about 2022, things were really starting to slow down. So the comps are a bit easier. Year to date, you can still see we're well below where we have been. But remember, 22 had a much stronger start to the year. But again, we're kind of finishing in this weakening point, which again doesn't bode well for where the economy is headed at this point. And then just looking at just what's coming to the U.S., you can see that volumes are still a bit light. You can see they're still better than 2022, but 2022 at that point in time was not a good period in time, was still a very big problem. So it's not like we saw this big saving grace in terms of some of the different pieces. So again, this continues to be an underlying problem and showing, the consistent weakness in the market. This is looking at just, the heat levels. You can see that some of that heat is moving over into the East Coast. The East Coast is one of the largest consumers, especially in this type of backdrop in natural gas. So you get a bit of a reprieve, but then you get some of that coolness that comes across really from the Rockies West. Rockies East starts to get a bit warmer, but we do see things getting a bit colder as we head into the end of the month and then kicking off in November. So then when we look at gasoline had a draw of 2.37 million. You can see that puts us pretty much right in line with the 5-year average. Things are pretty stable. Finished motor gasoline had a drop of 1.141, but blending components only dropped 960,000 barrels, and that's still 4.5 million over the 5-year average. Imports had a big bounce, and again, it went too low. So again, this is that managing, that balancing act that we've talked about. So we do see this gasoline storage kind of, it could be one more draw. Realistically, it's likely to kind of flatline at this point. And rate of change is going to be really important because we do think that even if it does continue to fall a bit, the rate of change is going to flatline, and it's still going to be at a much higher level than it has been in previous years, just because prices are still elevated. People are still struggling a bit, not looking to move around, and just the inherent push to create diesel and distillate is going to put more gasoline in storage as refiners try to manage that. Here's, you've seen the gasoline crack kind of find a bottom here. We don't see too much benefit to the upside. If anything, it's going to kind of bounce around at this point in time. And most of the heavy lifting is going to be done by the diesel crack. So then when we start looking at demand levels, blending components, you can see the only time it was higher was in 2018. We're above 2021 levels. We're above 2020 levels. And because petchem demand is still so weak, we see this remaining elevated, and likely we should see this actually remain at the high end and likely set new all-time highs, seasonally adjusted speaking, obviously, in terms of where we are and where we sit, given the slowdown in demand. And just winter grade doesn't have the same blending side. So again, you're going to just inherently get a bit more coming through and into the market. Then when we look to traffic data, you can see that Asia Pacific is just below where we were in 22. We have had some confirmation. South Korea is going to keep some of their subsidies. You're going to see some subsidies hold in for a bit longer. So we don't see a huge drop. We've started to see some subsidies get walked back in more of the emerging developing markets. So that's why you're a bit lower, but we do see that weakness continuing. Europe didn't get to where it was in 21, didn't get to where it was in 22. You can see it's starting to roll over a bit, and that's where we do see that drop continuing. North America, you had that nice pop, and now you're starting to kind of normalize at this point, and we see it just kind of essentially hugging where it was in 22, which is still below those 2019 numbers that we've talked about. Here's the gasoline price situation that we described. So you could see that gasoline prices have started to come. I shouldn't say normalize, because you can still see how high they are, but obviously still back to where that initial pop was. Diesel is starting to come down, but again, it's still elevated. But guys can only hold off for so long, so that's why you're holding off, trying to get better pricing. Some of those prices have started to come back down, but even as they come back down, guys have to buy, have to make sure that there's enough product in order to keep things moving. So we do see diesel prices continuing to weaken, but again, not to the same degree as gasoline prices, which is why you're going to see that disconnect remaining, and it's going to put and keep pressure on that PPI number, or the producer price index. Here you can see that nice bounce in crude demand, in gasoline demand, but still below the 10-year average. We typically get a bounce at this point in time, depending on timing. It's either the week before, the week after, but we're right in line. We do see a little bit of a normalizing, but not like we're going to go from 8.9 down to 8.2. Really starting to settle out at about 8.7, which is right about where we sit at this point in time in terms of what we see in the market. Propane, propylene had an unseasonal build of 810,000 barrels. That's 15.7 million above the 5-year. Again, we're producing a lot of NGLs, a lot of condensate, where even though we've seen an increase in demand based on seasonal norms, crop needs, exports, there's still a lot coming in. So we do expect to continue to make all-time highs, seasonally adjusted, as well as not only just yearly when you look at underlying storage. Jet had a small build of 130,000 barrels. We still hold to demand staying between 1.55 and 1.65. You can see that there was a bigger drop. We do see that coming back up. Some of the departure schedules have softened a bit. When you look at Western Europe starting to slow, it's slight gyrations. Same with North America. Really not a huge amount to point to in terms of those slowdowns, but just moving more along seasonal lines. For those that have had the unfortunate opportunity to fly, you can see cancellations still remain problematic, which again reduces some of that underlying demand. TSA, and now it's important to put this into perspective. 2019 started to weaken towards the end of the year. So realistically, 2023 should be stronger than 2019. And we see it maintaining that strength against 2019 levels, especially as we get into year end. So I expect the U.S. to continue to outperform against 2019. And then the same can be said in Europe. It's not going to go above. It's just going to get much closer to 2019 levels. And it's just because 2019 and for those that have gotten our insights, listen to me speak, I'd been saying that 2019, was starting to see some bigger slowdowns, as we've shown in rail data, as we've shown in trucking data, and the same in passenger. Now, when we look at open table, you can see that global eating out has come down. It's continuing to weaken. We don't see that changing. The U.S. is now 5% below and getting worse. And I think this is kind of the leading edge for consumers, because this is realistically the easiest thing, if you will, to see drop off, which we think is going to be a continuation. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into what is happening abroad, how are things impacting flows, and get a bit deeper into the global market.